Good morning, everyone. Hope everyone's having a wonderful day. So, we're going to go ahead and go over the Fed meeting that just occurred so that you guys can just have a better understanding from a real estate perspective how that's going to affect what's kind of coming in the future. So, what did they reveal? So, I made a couple posts about it, released that obviously they have increased the Fed rate 75 basis points. So I'm just going to kind of go through my notes and just take it line by line so that, again, you can kind of have the summed up version of that long meeting that they just announced. So they do have a dedicated and aggressive approach to bringing inflation down to 2%. They reiterated it many times. Ideally, my opinion and the opinion of many others is that 2% is probably not the realistic target. So I'll get into that in a little bit. Growth, it has seen a slowdown, but prices still are being seen with some sort of increase. The labor market is out of balance. There's still a demand for workers, but that is slowing down and unemployment is slowly climbing a smidge. The war in Ukraine has caused us and other world economies to be tapped due to assistance. They did mention that this will take a while, so this is not a 3-month, 6-month inflation correction that they feel. They feel it's going to be a year or so from now for that correction to really take place. They do want more data to really determine that there is a slowdown due to data being lagging. Growth, what they want to see is they want to see growth below trend. They want to restore price stability. They want to see a softening in the labor market and better evidence of supply and demand, and basically evidence of getting closer to 2%. Again, is that likely? Probably not. Their idea is that they will need to bring the funds rate to a restrictive level and believe this will be for some time. They didn't actually tell us what restrictive is, but based on their rate hikes going on for the remainder of the year, they do feel that those will be restrictive enough. We'll move on to the next one. They understand that the effects of their inflation rate hikes lag 3 to 6 months, if not further. They don't care that they are going to have that impact. They want to essentially kill the inflation or kill inflation and basically slice out the wound. So like I mentioned in a prior video, I did mention that essentially they have a couple standpoints that they could take. They could let it drag on, they could band-aid it, they can just let things kind of carry on, which would be worse. And the other option is to kind of take a mid-level approach, and then the other one is to cut off the wound. And this is initially they had kind of let it drag a little bit because they're waiting on data, but now they're cutting off the wound. So that just means they don't care. They want that max pain and they want it to come as quickly as possible. I do agree with that. I do like that standpoint, because even though we'll have pain for, let's call it 2023, that means 2024, 2025, and so on and so forth, we're going to see a lot of easing and things just really improving and trying to maintain those levels instead of making them worse or hike up or things like that, or prolonging a max pain in the future. They feel that they are in the lowest level of what they feel is restrictive. So that basically tells us that we're at least within the zone. So hopefully by the end of the year, with their next 3 hikes, that they will be enough. Soft landing, that was a question that was asked. Essentially, no, we're not going to have a soft landing is basically their standpoint. This period has not been seen in past historical experiences. So as far as the past goes, we haven't had supply shocks like we have had during the pandemic itself, stimulus checks, things like that, for example, the war in Ukraine, all of which don't normally happen. So because of that, again, this is new territory for them. They are watching vacancies and quits reports in relation to the the labor market. So that would be a good chart to be able to watch. If you go on to any of the resources that I do in my market update, they are on there. 100 to 125 basis points potential by the end of the year. There's 3 more left, so 50, 50, 25, or 75, 50, 25, maybe making it 150. It just depends. Is that 150? Yeah, that is 150. Okay. Yeah, so in that ballpark is where they do feel that they're going to have to take it. So ideally, again, we're going to see some more rate hikes, some more increases, but hopefully they're kind of planning that to be enough. They did say core PCE was a good indicator. Just Google core PCE, and you'll be able to find it. It'll pop up, and you'll be able to see the chart. I believe it's with U.S. Treasury, or I just pulled it up on Google, and you can look at trade. The first one that pops up, trading at economics.com, just pops it up. You can see the core price index. Just pulled right up. Now my computer's going slow, so there it is. Yeah, core personal consumption expenditure price index. You can see the previous to the actual. So if that one is actually going down, is what they want to see. So below downtrend. Mortgage bonds and mortgage rates, that was a question that came up as far as what they're seeing as, as far as, are they even considering easing, or have they even talking about it? And essentially they said, no, it's not a consideration at the moment. They don't foresee it in the near future, which means through the end of the year. So that's not even a question that's going to come up, or they don't plan to even discuss it. They may by the end of the year in their last meeting, but essentially in their next meeting and probably the next two meetings, there's no mortgage related questions or interest rates in that respect. Job loss is imminent based on their outlook, potentially in the 1 to 1.5 million range. Essentially they understand that, hey, we're going to cauterize the wound. We're just going to cut inflation. Even if we overdo it, we don't care, because we want max pain to come right now instead of prolonging or band-aiding the situation, which is not a normal government theme. So that's also kind of it's actually a good thing, but also not a great thing if they do it too much, because that could have some other effects on our economy. But outside of that, again, if we're looking at job loss, ideally in the 1.1 to 1.5 million range. It could be a little bit less than a million, could be a little bit more than 1.5. Again, this is just a general range that we're kind of anticipating to see based on his response. It's just a good range. So what is the actual path? That's the question. They didn't actually give an actual path. So it's kind of in limbo, and there's no real data that they're sharing with us as far as what they're really tracking. Inflation is currently, they did mention that as far as, your average worker, especially in the lower income brackets, their income is being eaten up by inflation. So they want to correct and bring max pain now, even if there's job loss, because let's say in a year or 2 years, they're like, well, that person's going to go back to work. And okay, it sucked for a year or two, but guess what happened after that? They were able to go back to work, make their money, and now they have money left over for savings and whatnot, or ideally they should have money left over for savings, because right now their paycheck is going all to bills, to gas, to food, to things like that, and some don't even have enough money from work to pay for those things because inflation is so high. They're not entirely sure on data they are really basing it off of, so again, they're not really giving a direct answer on that. They're kind of bouncing all around and just going back to reiterating that they're dedicated and aggressive in their approach to bringing inflation down to 2%. They are for higher consumer rates to fight inflation. So on credit cards and things like that, again, they just feel that you need to just jack up the federal funds rates up as high as they can go in order to correct this inflation. Real estate values. So they did talk a little bit about real estate values. There's one question that was brought up. So they do feel that real estate values will pull back with standard inflation. They're going to pull back, but they're going to pull back to standard inflation levels. So they brought up an example, which was someone would pay 10% over asking within a day without even looking at the home. And they're like, that's just not acceptable for standard inflation. And that was a big issue. Whereas the homes, like home values should have, let's say it was 100,000, over the course of, 5 years would go up 2% each year. So you would see, 2000, whatever, like we'll call it 2100, 2200, and it would have a standard increase. And so it, in 5 years, it should be upwards of, 111 or 115,000, somewhere in that ballpark, not 100 to 180 or 200,000. Which is what was happening. And so ideally, it's just a matter of what were those levels. If you wanted to go back and do math before, from 2018 to basically thereafter, and you can even probably go most of 2019 as well, maybe even parts of 2020, and kind of bring it back a little bit to see kind of where those prices were and where they should be. And that's ideally the point where they want to bring it back down. So if your home was 400,000, maybe they want to see that home at 320. So this is a good sign, because it's like, hey, we're not trying to crash the market. We're not trying to take your home value from 400 down to 100 or 200. We don't feel that it needs to go that low. We just feel that we need to have some easing back with standard levels. So you will see some easing, but they want to keep the home values increasing with standard inflation levels back at that 2%. So that's actually a really good thing for real estate. We'll go here. So shelter and rent, they do expect that shelter or rent is kind of the bulk of shelter, is going to continue to remain high with inflation. So rent, as far as like the cost to rent per month, that is going to continue to rise or stay high. So again, buying a home, paying rent, if you're going to pay so much in rent, again, that's a good indication for when you go to talk to a consumer, hey, the Fed plans to keep rents high all over the country. That's essentially their MO right now. So if they're going to keep, I do apologize, my windows are open. If they are going to keep rents high, why not buy a home right now? You're gonna have to forego the payment on rent. You might as well forego it on the mortgage, and then obviously you'll refinance the minute rates come back down in a year or two. There was a question on the question is overcorrection. Are we going to be overcorrecting? 100 to 125 ideally looks to be the peak of where they're looking to take it, but is that too much? Now again, these are going to delay what actually happened, like the effects are delayed. So again, if by the end of the year, if they raise up the federal funds rate another 100 to 125 basis points, and that's going to take effect into the economy in 6 months or 8 months or 12 months, whenever that happens, is that going to be too much and really have too much of a downturn to where they have to pump in stimulation into our economy to level it out? And then you kind of play this game of, okay, so we came all the way down, now we're going to go up, and now we have to try to find this middle, and that's just more time that they're kind of delaying it or taking it, when we can just kind of slowly ease our way down, which is the other side to it. They do plan, he did mention, so this is more of a dovish comment, which is, again, think about easing, dove land, hawk, soar. So as far as the dovish statement here, they do plan for a significant correction after fixing inflation on rates. So ideally, when you think mortgage, you're going to think, hey, they plan to correct rates and come in with mortgage rate stimulation, essentially. So they're going to go into mortgage-backed securities, mortgage bonds, and they're going to ease them. So, we can be talking about, again, probably bringing rates back down to that 2.5% level, maybe even lower than that. So that's actually really good. So again, they had extremely hawkish statements, and they maintained that standpoint the entire time, but they did have some dovish statements which were different from Jackson Hole in their first meeting. So we do see some easing and caution that they do have, kind of starting to poke in with some holes. They do have a lot of mixed opinions on as far as data, as far as what needs to be done to correct inflation. It seems like they really don't know. It's just, we know that if you raise rates super high, that's going to bring down inflation, and that's kind of their standpoint, it looks like, at the moment. Anticipation, we can see definitely a rough end of the year. So quarter four, just plan for it to be rough. Quarter one, for sure it's going to be rough. Quarter two, probably it's going to be rough, but that's when, between quarter two and quarter three, ideally is when we should start to see some improvement and catch up. Or again, just some sort of movement on easing from the Fed, so that when Chairman Powell will come and speak, he's going to bring out some sort of easing. We're going to ease the federal funds rate to X, Y, and Z. They are looking for, again, that easing and negative growth over the course of a couple report periods. So hopefully we will get those by quarter two, quarter three of 2023, which sounds like we might, because then that will ease pain from quarter three to quarter four. We'll still have pain, but then they'll get into their easing phase, and then again by quarter four, quarter one of 2025 is when we should really start to see significant improvement. So again, I do apologize. Bear with me. Always fun doing this from home. All right. Lack of data is a real problem. Again, the fact that they don't really have a plan, or they have not given us data of what they have not shared with us the exact data that they're really going to use to really determine this. It's kind of all mixed all over the place. Here's this for that, here's this for that, but just really increasing the rate, increasing the rate, bringing it to 2%. Those, again, constantly repeated. Skated around a lot of questions as well. Markets will see some correction coming down the pike, so you'll see some sort of correction, but then after the correction, you're going to see, again, kind of a lot of wishy-washy. So you may see some easing here, but then you're going to see definitely downturns. So you're going to see some things look great, but then they're going to go ahead and spike back down. So just expect, a lot of volatility over the next quarter four of 2022, and then probably a little bit less volatility and kind of coming back into grip in quarter one, quarter two, because we'll probably just hit a downtrend. And once we hit that downtrend, again, we'll kind of be able to balance out or have a solid direction, which is what you want. The less volatility, the more mortgage programs will open up, the more mortgage companies are able to do, because there's, again, less volatility, a direction determined, and now we know what to do with this direction. We're not just in limbo, which is where we're going to be the rest of this year. Which, keep in mind with that, again, investors are forward thinking. If they price into their, so when they go to price out the rates, the investors, so think, again, investor prices out their interest rates at the open market for all sorts of loans. Okay, there's loan level price adjustments and whatnot. When they go to price out those rates that they're going to purchase, it's a promissory, like, hey, we're gonna pay X lender for like this amount for that loan. Then what they're doing, essentially, how would I put this? If you refinance that loan in 6 to 12 months, okay, so they're fitting their budget, number one. So whatever their budget is, they need to fit that, okay? Then there's risk. That's also, so risk reward, think risk reward or return. So they price in their risk for X loans. So again, lower credit score, more risk. Their return, they want to make sure the return meets their budget, possibly some profit for themselves. But if you refinance the loan, like that person buys that home and then they refinance, that's a risk to them, because they will lose their premium check from Fannie, Freddie, FHA, USDA. Okay, so if they're going to lose that premium check, they're going to lose profit because that person refinanced super quick. They will bring rates down. Maybe their budget is not entirely met, but they'll forego some things on their budget because they want to make sure that loan doesn't get refinanced, and they want to capitalize at the higher rate, especially when rates go down. So that means they make a little bit more money in interest, even with inflation and things like that. So keep that in mind, that when with these reports, this gives them assurance that they're going to be able to capitalize a little bit longer, so rates can go up. So keep that in mind. So this is giving them the ability to raise rates for a little bit, and then we'll see each meeting if they need to adjust from there. Okay, so again, it's all based on investors. Investors pay lenders. It doesn't matter who the lender is. All investors determine one price for one loan, and it doesn't matter who that client is, no matter what lender they go to, they're going to pay the same thing. The rest is lender margin. That's the difference. Okay, cool. So we may see some relief from time to time. Again, you're just going to see kind of wishy-washy here and there in the markets. So new, old. So expect new. We're already starting to see some old products and possibly some new products, but mainly the old ones like 40-year mortgages. I would say adjustable rates are coming back just from affordability standpoint. Old good lending products to be reopened. So we're not talking like interest only crazy stuff. Certainly there are some non-QM stuff that people can get into. They're kind of leveraging that as more of a band-aid loan or a bridge loan style thought process. Like, you're going to be in this one for a year, you refinance, call it a day. But at the same time, you'll see probably like 40-year terms. Again, adjustable rates, a little bit easier, a little ease on adjustable rate pricing, margins being cut, things like that for just volume. Because again, if you can simply do X amount of volume, you'll still make money. And that's kind of the goal that most lenders are more leaning towards. But if you can do like a 40-year term, that just qualifies more. So they're trying to, mortgage companies, you'll see, will try to create new markets, and so will the guidelines as well. And the next one is the new normal around 3% for the inflation rate? And that's a big question as far as, is 2% really that level? It's always been kind of 1-2%, but is it really going to be around 3? So over years and years of time, they redo the metrics that they use to calculate inflation. If we use the original metrics, we would be at 20 whatever percent, and everyone would freak out. So with the new metrics that we have, and maybe we've had these same metrics for, and I don't know, maybe like 10 years or 15 years, and they haven't redone them for that period of time. With inflation growing, maybe it is upwards of 3%, and that's the new normal. So I think they're going to have to figure out, and based on other forecasters have advised that they're probably going to have to adjust to a new norm of what inflation actually is. So it just depends. It may be 2%. They did mention 2.1% being an acceptable level, but we'll see at 3% if that's going to be acceptable as well. Investors ideally are going to look at this as very hawkish, with the hope of some dovish sentiment from the end of the year and into next year for easing and downtrend. Again, expect more of Q2 maybe, but Q3 probably. We'll start to see more of an easing on things, and also more of that downtrend as well. And then how Powell responds to be in the beginning of next year, and even over the course of the next 3, but probably like December and beginning of the year will be very powerful as far as the ending in sight for recession and inflation and how things are affected. Because especially at the beginning of the year, right now we're in September, some of these effects are going to take place, and they're going to affect the economy through the rest of the Q4 of 2022 or this year. So what he says in December, we will have effects that have taken place, and maybe we did too much, maybe we did not do too much, or we did not do enough, or maybe they see that easing that they want and they can start making things better sooner. We do see, if you actually look at the the inflation rates, you actually can see that inflation had been going on longer than people were even made aware of it. It actually jumped up from 2.6%, which is still considered relatively normal, to 4.2 in April of 21. So we've had inflation continuing to increase since April of 2021 above normal levels. So if you take that into account, we're already a year, 1, 2, 3, 4, 5 months into it. So now that that inflation's coming in the correction, if we go to 2008, so, and it did not take that long from 2008. We saw one period in 2006, or in 2005, 2006 had a period of less than, we'll call it a year and a half. Call it a year and a half, maybe a little bit more. And then it started to ease. And then it kind of maintained around 2%. And then it jumped right back up in 2008, obviously, because of what happened. And then you look after that, again, kind of the same thing, and then it kind of went back down. So 2008 was a big issue. There was already a correction happening in 2006, in 2005, actually 2004, the very end. And then that ended up carrying us through 2006. And then again, the whole issue with 2008, which is kind of an oddball in the equation. But then you saw things really ease really quickly, which again is what the Fed's standpoint is that once they see that easing, they're going to come in with like a whopping, they're probably going to print money. They're probably going to, again, lower interest rates, things like that. Lowering interest rates was a big one, like really lowering interest rates, not like here we're just going to like take it down a little bit either. So there's kind of the standpoint from the Fed, but for how long we've been into it, I mean, again, ideally you'll see September, October, November, we should start to see come that November, December mark, and then obviously January, February, March, they're going to want to see those numbers going down, and ideally we should with what they're doing. So hopefully that's what happens. They feel it is enough. Let's just go back here. Was there any more points? Nope, that was it. So again, real estate, just expect kind of a little bit rough, but for the next couple quarters, so Q4, Q1, Q2, and then again you'll see more of the effects in Q1, Q2, Q3 of 2023, but then there's recovery as far as the mortgage rate side, and hopefully we will see, again, not too much job loss, but especially if you're a buyer's agent, this is a great time for you. We are in a buyer's market. We are no longer in a seller's market. Seller's market is gone. There are some select areas where you can say it's still a seller's market, but just know with all of this information, we are in a buyer's market. So don't let anyone fool you. Again, relate this to your specific location. There's certain areas, I mean, I'll throw Cleveland, Ohio in there. From what I see in Pittsburgh, they've had lack of supply for years. Those are kind of like the two oddballs, and then certain parts of California and Florida. But outside of that, everywhere else has sufficient supply, and everyone has enough homes to look at and purchase homes. So we are in a buyer's market. Seller credits are a thing that are coming back. I'm seeing it way more at this time. So expect that to become a new norm once consumers adopt it, once more homes are on the market as well. This may affect homes going on the market with job loss because people will want to keep their home, take out debt to pay their mortgage and things like that. Or they'll sell the home for, whatever cash they can make. But, again, it's just going to depend. So just use this information just for your business and how it's going to affect your business and everything that you can do with it. And just stay informed as I keep you updated over the remaining part of the year.